this is a presentation for Horizon Apartments, 204-unit complex in San Antonio. We already closed on the property, so this is a done deal. No more waiting. It is a 506 opportunity, so only accredited investors are allowed, and we can talk a little bit about that. And as we go into this, or if you have any questions, we will have a lot of questions. Feel free to put your questions in chat as you think of it while I'm going through this. But if not, feel free to ask it at the end. From agenda, I have an executive summary, sponsor team, property and market overview, and then I'll hand it over to our partner, Vinny from TVG, to talk about the business plan, underwriting, and how to invest with us at the end. So without ado, before we start, this is a risky investment, no legal investment or tax advice. This is a deal with future projections, and any historical return are not any indication of a future return. So keep that in mind, and let us know if I can clarify anything around this. So sponsor team. So on this one, we have Massive Capital and TVG are the main sponsors for this deal. In addition to that, we have a couple of the GPs who are joining us. So from Massive Capital side, me, Schreier, and Mike. Mike is also on the Zoom today. From TVG, Texas Valley Group, Jose, Nacho, as we call him, Jose, and Vinny, and Tom, also part of it. Amber and Janae, with their golden ratio, they are part of it. So Tom is local in San Antonio. Amber and Janae are only an hour in Austin. I'm in Dallas. Mike is in Houston, about 2 hours away. And Vinny, Nacho are in Mexico City, but only an hour flight away. So amongst the team, we have about 20 deals to date. Out of those, 27 are full cycle. Currently across the team, and I think if we count everybody's, I think Amber and Janae's deals are counted in this. We have over 3,000 asset under management, asset owned in Colorado, Georgia, North Carolina, and Texas. Within Texas, of course, Dallas. We have deals in Dallas, San Antonio, and Houston. So have a good varied experience across the market. Liz, Barbie, Mary Jane, Ronald, Luis, Brooke, and Dan also here. So some of the people who are attending may be coming through them. They are part of the team, working with us as we evolve and review. Once we close on a monthly, quarterly reviews, we bring in the team, full team. So from executive summary perspective, why we love the deal, it's a very strong sub-market. And I have a slide later, it shows how the I-35 from San Antonio towards Austin is a very strong corridor and growing. And this property is located perfectly in that area. We're getting a very good basis at 82 per door for this property. The story for this property is originally we made the first offer in March last year, where the seller wanted quite a bit higher. But as the market evolved, this has an assumable 3.78% fixed rate loan. So, loan conditions as the market changed did not change much, but we stayed firm on our price, and eventually that's where the market was, and seller and us, we coming to an agreement and from our perspective, got a very good basis for this. There's a good value add opportunity continuing the units that seller has started adding the value there. And then some of the other operational improvement with professional property management and efficiencies from our side. We like to think we are a great team, but of course, please ask questions, poke holes. But great sponsorship team, and sometimes it looks like a big team, but we have a very focused uh, from a decision making perspective. Vinny is on the front with the property management team, first interaction for any day-to-day decisions, hiring, firing, as we say. I'm doing the financial asset management with my team as a massive capital team, and with all the capex and the other moving parts, Tom, Amber, Janae, and other part of the team supporting us. So it's a great team. We have a lot of hands here to help, which comes in handy when the time is needed. So really, we think we have a very good sponsorship team with good feedback loop, great ideas. We've been bouncing ideas and already working on the capex plans for that. And great location within minutes of major employers. So our purchase price, what we purchased at is 16.9 million. It's a Class C building, and it's a rapidly gentrifying area in a C plus location. Just under 83,000 a door per unit, which comes to $95 per square foot. Uh, our equity that we planned originally 6.6 million, and as we close the deal and kind of finalize the financials and look at the reserves and everything, we will lock down the final numbers on equity required. Our PPM that you will see allows for a little bit higher equity raise just for allowing a little room as needed. Either way, whatever the equity, we would make sure that projected cash on cash is 7 to 8% with the projected IRR of 18%, a little more than 18%, and 2.1 multiple. So all of these numbers are based on a 5-year hold and a minimum investment of 50,000. As we said earlier, it's a assumable loan at 3.78% fixed, with about 80 years, just under 80 years left on the maturity. So we don't have any rush to sell or refinance or fight the market. So high level property, it's 204 units, total of 177,000 square feet, garden style multifamily, 2-story there. When we got under contract originally, which was back in September, it was a 96, above 96% occupancy. When we closed in January, December, January tend to be rough months. Most multifamilies have a higher delinquency, lower traffic with cold weather and the holidays and the financial, just the cyclicality of the market. So when we closed in January, the property was still in 90s, just at 92% occupancy when we closed. And it's in the northeast side of the San Antonio. And it's a 1974 built property. So there is the map that I love. Here's our San Antonio. There is Austin. This is the corridor. By 2045, 53% of the population between San Antonio and Austin is expected to live within 5 miles of this 35. So our property is right here. Okay, so we have another map. Yeah, so this right here, right off of 35. Very high traffic, 100 to 150,000 vehicles off of 35. Austin is the single largest source of San Antonio in migration, accounting for 20% of the San Antonio new residents. So San Antonio itself is gaining its own new businesses and headquarters, but Austin, as it expands along this direction, pushes and drives the growth in the San Antonio market. So one of the good statistics we saw, 4.5 million people are and expected to grow to 6 to 7 million by 2030. This whole corridor, San Antonio Austin corridor. There is a little aerial view. So this is turned a little bit to the left. This I-35 in the original map was going in this direction. There is our property right off of 35 and some of the distribution centers for HEB, Frito-Lay's, Pepsi, Amazon. And this one, I believe, when we were driving, is a brand new, or maybe it's this one, the brand new warehouse that is completed. And they would be bringing in, and of course, the recruitment and jobs start to come along this direction. But great access to the highway and proximity to a lot of jobs in the market. So value add and the property, I'll hand it over to Winnie. Winnie, you want to take it from here and talk through the property details?
Yeah, Sanjay, thank you. So good night, everyone. Thanks for being here, and thanks, Sanjay, for explaining the fundamentals behind this investment. So basically, this is a value add opportunity. What that means? It means that we are in a strategy of purchasing a very good location, a very favorable location with easy logistics, very good employers and diversified economy. And what we're basically gonna do, we're gonna do some interior upgrades to make sure that all units that we have, most of them are remodel. We have still 28 units that are remaining classic. So we're gonna bring these 28 classic units to a remodel, which is a very basic remodel. We're just gonna put some mortar, brush, nickel hardware. We're gonna be putting some new basic stainless steel appliances, low flow toilets, faucets, and shower heads. So we're gonna have some savings on water as well. We're gonna get a fresh paint on entire apartment and other very, very low cost but high impact cosmetic improvements. Again, we understand the demographics, we understand Class C, so we think this is gonna be a competitive product, and we're gonna push this on the interior side. On the exterior side, we're gonna have some potential conversion of the still on the side to convert some space office into a new unit. Also, there's a clubhouse that is currently used as a storage. We think that is a waste of money. We're still thinking on how we're gonna convert that into a income producing unit, and also about implement the water conservation program. So that is one thing that it's also on the cost savings spectrum. On the exteriors upgrade, this property needs work on the roof. Basically, we have a considerable amount of capex towards roof, siding, patio, and also balcony repairs. There are some parking lot and concrete sidewalks that we're gonna need to put some effort and just show some love. Exterior lighting with LED that has a phenomenal effect on curbside appeal. So getting that on the night, well enlightened, it typically gets a very, very nice impact with prospect and current tenants. Landscape, curbside appeal, there's a playground cover. We have a plan for parcel lockers installation. So that is a service that whenever tenants order some Amazon orders or any type of e-commerce, they will get that into a locker. We'll just plug in a number, a small door will open, they will take their package home very safely. On the revenue generating, we're gonna add some storage units for rental. These are small storage that people can rent, and that will be one of the other income generating ideas. And then there's also some property fencing repairs that's needed, signage for the building and office location. It all helps conversion. So this is in very general aspect what the plans we have for implementing and executing capex. So here's some ideas and some pictures actually of our plan. So we already spoke about the exterior mini storage, the package locker on the right top. We also have a very effective way of generating other income, which is a spectrum technology package, which include cable and internet for a very special price. We offer them at a promotional price, and that's the margin for the property. And there's also QR parking that's also implemented by the previous owner. We plan to keep that, and the charges for parking overnight. In the area, there's no parking available, so we think this is something that could help the property get additional revenue and also bottom line. Okay, business plan. So the first thing which you already did, implement a professional property manager. So this property was owner managing. So there's a lot of opportunity in terms of marketing efforts, in terms of anything that's related to underwriting tenants correctly, measure their risk models, everything that's related to that. So we're big fans of implementing a portfolio that holds a nice system behind. So people, they have ways of paying their rent. We don't take cash, so everything goes through the portal. So that there's a lot of efficiencies there. So this is already underway. So enhanced marketing, professional property management, also some appreciation events. On the revenue initiatives, I already spoke on the previous slide. We're also increasing the rents from classic units to remodel. There's a rent bump there, and we are very confident that we can get to current pricing. We're being very conservative on the pricing that we're projecting on our underwriting. For the utilities expenses, there's a water conservation program. There's also a quick maintenance terms with on-site staff, which we're currently hiring. LEDs, exterior lighting, and electricity contract negotiation, which is something that we already also are about to finish. Curbside appeal, very general, what we're doing to make it look nicer, a local marketing plan, mailing campaigns, having banners, having flags. We're talking about putting some really nice logo on the property signage, which is sort of a totem type of thing. So we're excited about getting that, and also enhancing the referral programs, which is also a very good lead generation strategy. On the rehab, turning remaining units, so we plan to finish in 12 months. These 28 classic units. It's a fairly achievable plan. So we think that we're going to be able to have 100% of the units turned. And also the conversion of units, clubhouse and storage into units. That is also, we're currently doing some bids on that. And then optimal time for property sales. That is, of course, we'll be monitoring the market. This is a cyclical market, as we all know. Like 2 years ago, the liquidity of this type of product. Currently, this is it's a buyer's market, so that's why we're buying. But it's nice that we have flexibility to sell, as we still have almost 80 years of assumable loan to capitalize on that. So the buyer could still have some time to have this property and still cash flow from it. So we think it's a strong way of maximizing our returns. So we underwrote this property with very conservative, so we're not bumping rents a lot. We're very just raising to the top of what we were already being executed, and then the typical single digit increase. So we are offering, the terms are a 7% preferred return, which means that we don't have any variable or any carry interest if we don't get at least 7%. So 7% goes 100% to the investor. The partnership, it's 18% target IRR. So this is that's including our fees. So this is one of the highlights of the investment. Average cash flow between 7 and 8, equity multiple 2.11, annualized return of 22 and 23%. It's a 70-30% split between LPs and GPs, which is after the 7%. The purchase cap rate is currently at 6.5. The exit is estimated at 6. We are raising 6.6. That is including all fees and the capex. We are not drawing capex from the lender, so we're raising that money. And some of it is already escrowed with the lender, so it's full disclosure. And 5 years, it's a hold period. So this is a projected returns on 100% on 100K investment on year 0. So year 1, we're projecting 5.38% cash on cash return, 7.53 on year 2, 8.44 year 3, 8.71 year 4, and then 9.32 on year 5. So if we take the distributions along with the profits from sale and the initial investment, that's where we get the total cumulative return and the original capital. So that's the 210K, which accounts to 2.11% of equity multiple. And we take this investors first approach. So everything that goes towards the preferred rate first, 7%. When we get to 7%, that's when we start getting paid as general partner. So that's very important to mention at 70-30% split. So that's a little bit of on the projected returns. Fee disclosure, we have a sponsor carry, which is 30%, is it a 70-30 that I mentioned before. So again, 30% after the 7%. Asset management fees, 2%, 2% of gross income, not AUM. Some funds out there, they charge an AUM. That's a lot more expensive. We think we're a lot more aligned with you, with limited partners. If we charge what we're actually able to collect, so if we increase revenue, we're going to be charging a little bit more of asset management fee, which it's basically the fixed cost of the general partner. Acquisition fees 2%. That's a one-time at the beginning for sourcing and structuring the deal. Disposition fee, we are also incentivized and compensated based on as much as we can sell the property for. So 1.5% is one way of being aligned with limited partners. And also capex project management. We haven't considered that in our underwriting, but in case we have to incur into any type of construction, and there's some higher level that's different from the turning units, that will be 5%. But again, that's not considered currently, but we have to disclose in case we need to do that. It will be, we need to make sure that that's transparent. Okay, sources and uses and loan assumptions. So the investment summary, as Sanjay already mentioned, it is a $16.9 million purchase price. Loan down payment is at 4.2 roughly. We are targeting around 1.2 of capex. So these will go towards the property, on improving the property, and making it look nicer, making the amenities look nicer, everything that's related to parking and curbside appeal, attracting the new type of tenants that we're targeting. Closing costs, acquisition fees, these are related to fees of the acquisition and sourcing the deal. So that is $591,000. Operating reserves, we're keeping a really good cushion for operating reserves. That means that we can finance any capex as we need to wait on capex draw from the lender that they have under escrow. So we're being very conservative on this, so we don't have to worry about being short and not being able to execute any of our plans. So that is a total capitalization of 6.6, which is our raise. On the financing terms, as we already mentioned, loan assumption. So what is a loan assumption? Some people ask this, right? So loan assumption basically is this property had a very favorable loan that they were paying fixed rate, 3.78, which currently is pure gold. Like if you go out there and try to raise money with that, that's going to be above 8%. That's going to be around 9%, right? That's really, really, really tough to get. So this is a 30-year loan amortization, 70%, 75% loan to value. So 3.78% fixed rate. So it's still 8 years remaining. and we're already paying some of the interest. So this is also, you know, amortizing the debt a little bit. And because we had such a great deal on the purchase price, so the financing partner, which in this case is Wells Fargo, they were able to offer us a supplemental. So Sanjay and the team worked really, really well on getting this additional 2.5 million of loan at 8. And actually that actually is 7.74, 7.74, not 824. But that's the actual closing of the loan. And then the loan was a little bit under that. I think it was around 2.3. But that's, you know, these are the final numbers that we got on this closing. So the blended rate is roughly around 4.5, okay? Fixed rate. So we don't have to worry about any type of you know, coverage or any type of high costs on predicting, you know, is the rate going up, is the rate going down? We have full capacity of planning of what's our loan service going to be. So that's a really, really nice thing about this project.
Yeah, Vinny, can I add a couple things here?
Yes, go ahead.
Yeah, so as Vinny mentioned, of course, the supplemental loan detail, we don't know the actual detail. This was the quote that was given by Wells Fargo, and we find out the actual when we lock it, which is the week before closing. So the actual interest rate ended up being 7.74, so you know, 0.5% lower. Um, like I was saying earlier, the occupancy dropped a little bit with the seller. So the proceeds of this end up being 2.27, just under 2.3 million. So our proceed did drop a little bit. Um, all this to say, you know, whatever changed, we will reassess and look at the final underwriting, and we're going to make sure that the returns that we are projecting here do not change for the investors. So whatever hit we have to take on the GP side, we will, to make sure the returns, projected returns, stay the same here. Vinny, back to you.
Yep. No, thanks, Sanjay. Okay, the pro forma. So most of our strategy is keeping the rates we're not bumping crazy percentages of rates. I've seen underwritings being very optimistic on that. So we're pushing a 6% on first year, 5% on year two, and then a 3.33. So that is we see that as a conservative approach. On the first year, on that side, we're also being conservative. We're pushing vacancy to 12% for year 1 and 2, and this also accounts for renovation downtime. And then we combine a 9% vacancy bad debt for years 2 to 5. Then conservative other income. You can see we're pushing 20K first year, 20K second year, and then we're just merely pushing, which that accounts for basic QR tech package. You know, rolling out currently the property adopted by 30% of tech package. We're considering rolling out to 50% of the property, and we think this is a conservative number. Real estate taxes. So we're pushing real estate taxes up. As y'all may know, this is one of the uncontrolled expenses. So we're putting 4, 5, 15, and then raising according to the expenses, expense escalator. Insurance, we got some really good deal on insurance. So that is that's something that we were considering. We're able to secure that, but the number went up a little bit, but it's a lot under the second year. So this is one of the strategies that we are also pushing. Contracting services, we are using conservative numbers. We typically did not try to just remove things and just go down on expenses. So we're bumping that up. It doesn't mean that we're going to execute that, but we're making sure that if we have to, we have that number considered. But for example, contracting services, we are considering putting inside, right? So, for example, landscape, pool, services, everything like we would like to do with our staff. But in the case for planning purposes and just for underwriting, we want to be on the safe side. Electric, it's already considering the negotiation with tax, state tax that will be exempt. The water conservation, we are putting in March a plan to reduce consumption, toilet, commodes, shower heads, everything that's related to water. Legal, we're keeping the same management fee. We're considering the property management company that we hired. Repairs and maintenance, again, we're putting here a very conservative amount to make sure that we can deliver the units turns on time. General admin, there's a little bit of an up, and payroll too. Advertising, the property did not do any advertising in the past. They were just doing referral. We think they didn't have a website. They were not very digital. So the first thing we did, we launched our website. It's live already. We are also authorizing PPC campaigns for Google, Rent.com, and also Craigslist. So this is one thing that we think we're gonna be able to attract a better number of tenants, a higher quality tenant, and we're also gonna be able to underwrite the lower risk tenants to come and live the property. One thing I like to highlight and just finalize this is that our operating leverage is to decrease the expense margin from 54% to 51.4%. So this is, we are making sure that as we grow our income, we keep our expenses under control. So we will be, at year 5 at 51% of expense ratio divided by the income. So this is most of our underwriting strategy.
Can I add another couple things here?
Go ahead. Yes.
So there is a poll that got open. Please feel free to take that survey/poll. I see the questions. Please keep them coming in the chat. We'll answer all those in the end live. One thing I would add on this slide is the 6% and 5% in year 1 and 2 may seem like a big jump than your typical 3%, 2% that we see. But really, on a T3, T1 basis, meaning immediately before purchasing, what the seller was getting on the rents was close to 250 on average. So we're really just bringing the property to where the seller was just before purchase. So the 6% and 5% increase looks like a big increase from a T12, but from the 2 months, 3 months before September, that we looked at the data, and after that, the new leases during our due diligence and stuff was close to this already. So we just have to kind of continue implementing what the seller was doing and doing. And as Vinny pointed out, repair maintenance, we're increasing, almost doubling than what the seller was, just so we have conservatively we can support the expenses and everything else. Back to you, Vinny.
Yep, thanks, Sanjay. And the next one is related to the comps. So we run a comps comparison to the similar properties. And actually, that was a tough job because most of the properties there in the area, they were Class A. And so we couldn't see a lot of comparison to Class C. And also there's no 3-bedroom comps nearby. So we think, the demand is clear. Like there's jobs, there are people want to live in that area. And there's still space for us to work on the pricing and bump rents a little bit on each floor plan, 1-bedroom and 2-bedroom. So we're keeping a close eye on them and making sure that we run this analysis very frequently so we can price ourselves and target our occupancy right.
And one thing to add, this property here, Nexus, is actually owned by one of the massive capital partners, Trevor. Trevor Thompson. So you can see this is the actual data that we see at the property. So we really think this, this property is one of the comps for our property, and we are able to push those. But as you can see, not a lot of apartments on this side, so kind of gives us that opportunity with other warehouses close to this area. Back to you, Vinny.
Yeah, no, sure. And as you already mentioned, like we can see like the strength of the new retail that are coming, that corner that's right by the property, it will be renovated, right? There's a rapid gentrifying area. So we need to, I think our entry price is really good to surf that wave. And this is gonna be, the same with the rental properties. So finally, the the exit. Okay, so our exit is our target period is to exit in 5 years. So our trigger to sale, it's reach an NOI of roughly 1.6 and a cap rate at 6. So there is a question there. It's related to cap rate at exit. So we are using some forecasts of cap rates that it typically has to do with the cycle of the market. So now it's a very low market. So caps are, sort of a weird to read. But this area and this property we're very, very confident that we can reach around 6% cap on the valuation. So this is the first strategy of holding it 5 years. Now, what happens if we decide to exit early? So if we hit a very, very consistent market of liquidity and low interest rates again, which we think, a good timing for that would be anywhere between now and 2 to 3 years. We also have that possibility of exit early. So we put a sensibility analysis, like what happens if we sell at year 3, year 4, in year 4, and then the different cap rates that would be executed the transaction, right? So anyway, we are very incentivized on the exit. So that will be for sure using all data possible, that we'll constantly monitor the markets to optimize the timing and also maximize investor return. So it is, for us, it's the most important thing that we exit well. And yeah, of course, cost segregation. This is a great benefit if you have other income, right, that you want to get some depreciation and do not pay taxes on that. There's a good opportunity there. There's also a tax bill that's now on the Senate to be approved. It's not 100% sure, but we are seeing, like, with good eyes, with our experts, with our cost segregation experts that are advising us on this, that there's a high chance that this will pass the Senate, and then that will go. I believe it's 100%. Right, Sanjay? It's that's where.
Yeah.
What's
So
on the
the
bill?
current bill original proposal was 100%. The expectation was it will knock down to below 100% before it passes the House, but surprisingly 100% passed. So now it still need to be past the Senate. So liking that, we've done the cost seg. It's a 60% of the real estate, the depreciable value that we can take as a bonus depreciation in year 1. So that's what's there. In year 1, we would take approximately 38%, and then the next 4 years, the rest of the 33% in depreciation. Uh, Again, everybody's tax circumstances may be unique, so consult with your own tax CPA or look at your situation. We're happy to answer any generic question or share our experience, what we think. But of course, the final is what you file, what your CPA tells you. But fingers crossed, we may get a 100% bill passed, in which case this property will qualify for 100% depreciation which you will get the K1 for next year. Nothing this year, of course. For this year's in next year's filing. So back to you, Vinny.
That's it. No, thanks, Sanjay. Um, Closing. Okay, closing already happened. So that is not a risk anymore. We got the property, we got the keys, we are already operating it. So some updates on my side on this. So we hired most of the staff, uh, property manager, leasing agent, maintenance supervisor. We still interviewing and shopping around for a maintenance assistant. So that is coming. Um, we also have implemented the system. So RealPage is already up and running with all the system, the rent roll, everything that's operating bank accounts related. We already currently having compared some bids for capex. And so we're getting our vendors, the best vendors out there to work on the roof, to work on the parking, parcel pending, luxury one, these guys that work on getting the lockers for the parcel. So again, this is a done deal, and we're finalizing the last tickets for the race, and we'd love for you guys to partner with us, and you guys come on board and join this interesting journey that we're starting here with Horizon Apartments.
Yeah, good. Let me take some of these questions here, Vinny, and
Sure.
you can chip in. So the first question, Ron asks, why are you allowing investment after opportunity has closed? And Vinny answered, basically, we raised enough to close. Of course, we don't need the full capital for closing. Between the capex and our operational reserves and some of our fees, we can defer. Um, so, and there was a portion of the raise that we were missing. So we were able to arrange some short-term loan to close in time. We did slip by 3 days, 4 days. Actual closing was on January 29th, but we did close in the month of January. So the total right now, I think we are just around 2.5 million total left to raise, out of which we do have commitments. And Maria or Mike can update on that. We do have commitments in the system, so it's still on a first come first serve basis. Sign up on the investor portal, create the account, sign up, and start reviewing the documents, and then once you have the funds, you wire the funds. So all that is still on a first come first basis, but um, one other thing that happened, the 1.2 million of capex that we originally we thought we didn't really need for closing, and we could continue to raise afterwards. So the total 1.2 million of capex, 600,000 of reserves, and another fees and closing cost of another 400,000. So that was about 2.2, 2.3 million that we could have closed without that. But the lender made us actually put 875,000 of our 1.2 million capex in the escrow with the lender. So Wells Fargo has 874,000 sitting with them that we had to bring to the table. But we have open about 2.4, 2.5, and we take out the commitments. We may have 12, 14, 15 slots left maybe, but that can change as the commitments changes. So hope that answers your question, Ron, but feel free to ask more. Any assessment of the AC and water heating appliances? Dwayne, absolutely. So United Apartment Group, UAG, which is our property management company, they did a detailed walkthrough with us. We walked the units, and ACs, they did an assessment for the ACs, and there was a situation. Vinny, you may remember how many ACs were missing the cutouts or
Yeah,
which the seller did make
had
the
to
billing
address.
for.
Yeah, they had to address that. So before getting into the property, they finished that work. And our maintenance supervisor will be HVAC certified, so we can, cut the costs on contracting this maintenance. I mean,
Yeah,
it is an aged property, right? So it will need work, right?
yeah.
But that's
And
what we detected in inspection. It was already addressed.
yeah, and AC and water heaters are changed on a rolling basis. You only change when that stuff breaks down. So age-wise, AC units tends to be some really old, some kind of metal, some newer, and that's kind of the distribution we saw, kind of normal for the property like this for both AC and water heaters. And our ongoing repair maintenance kind of covers some of the replacements for those. How did you determine the exit cap of 6%, which is slightly less than 6.5% at purchase? Good observation. Like I was saying, I think we got a great deal from this just because markets were tough in 2023. There was a lot of uncertainty, even though there was 8 years left on the loan. I'll get into why seller wanted to sell with a stable loan. But seller had a tough time with the market volatility to sell. But we think by the time 5 years go around, and could happen anywhere from 3 to 5 years from now, as the interest rates drop, again, a futuristic assessment, opinion, no guarantees here. But as the interest rates drop, cap rates are expected to drop. So any new buyer coming in with a new loan, close to 5%, for us to say 6% cap rate, 1% higher than the interest rate is quite a comfortable gap based on the historical data. And we looked at some of the projections of the cap rate on CoStar, which is one of the tool widely used for multifamily apartments and data. Uh, so the cap rates are expected to continue to push up and push slightly above 6 for the northeast corner of San Antonio market. So it's going to hit 6.25 early this year, 2024, and then it's expected to drop over the next 3 years to the 5.5% for that market segment in that area, and that's how we kind of put the 6% cap rate for our exit. So the reason seller, why there's a question, why is seller selling with such favorable loan terms for another 80 years? So this was a seller ran the property themselves. She was by herself, taking care of employees and repair maintenance and everything else. So it was a lot. She was ready to retire or take a break and jump into other more passive investments as the kids kind of get in that age where they need more time and it's more valuable time to spend with them. So, the seller did some of these terms, implemented the parking, implemented the tech package. So those things are kind of leading to the kind of what the seller could get the value wise, and then pushing some of the things to the next level. It was just out of their wheelhouse. So we're coming in from a perfect buyer in that sense, that professional property management, implementing some of the programs, and continuing what she started with the professional property management kind of gives us that leverage. So really, seller was ready to take some time off. um, the
Quarterly
poll, yes, please
distributions.
take the poll. Go ahead. Somebody had a question?
Now, there was a question about the quarterly distribution when they were happening.
Yeah. So, sorry, before that, why did the supplemental loan have so much higher interest rate than the primary loan since both loans were taken out in year 2020? Yeah. So, sorry, we weren't clear. The original loan was taken out in 2020, but the supplemental is actually now. That's why there was some variability also. We got the quote back in October last year, and the final rate lock happened in January 2024. And so that's where supplemental is at the current rate, but it is fixed for the next 80 years. So supplemental has the similar terms as our underlying loan assumption, except the interest rate. So our term of that loan, it stays fixed, and all those things are same for supplemental. So that's a clarification.
But again, you have to do the weighted average, right? Essentially, you have to consider like you're at 378% at the most, almost like around 10 million. And then you have 2.2 at 7.74. Or
Yeah.
7.4, 7.74, it's like a lot higher, but that's the market right now. So our reading is 7.4, 7.7 was good. And the blended rate, it's around 4.5. So that's what it kind of needs to stick. Debit service covered ratio will be very conservative, will be over 1.2%.
Yeah. Okay, Dwayne, I'll come back to your question about massive and TVG along with the day-to-day. But this question from Dan, will a RUBS program be implemented for utility bill back? So seller was actually already charging back. Okay, we kind of combined this. So seller was charging back the utility as a fixed flat fee as part of the lease. So when you look this here up, this is the leases with all bills paid, and on our comps, it's quite a bit lower because we took out that flat fee for the utilities to compare apples to apple across the board. So so that bill back at a fixed fee per unit is already there and is being billed back, and it doesn't show separately as other income. Now, to Dwayne's question, how many deals have Massive done with Texas Valley Group? How did you connect on this opportunity? So this is for Massive Capital and TVG. This is a first deal in a true partnership. But TVG and Massive, we've known each other for almost a year and a half now. We've been discussing deals with TVG since the end of 2022. Texas Valley Group, Massive, we met through one of the other real estate networking group. And we really like the team, what they have. They already have the presence in Texas, in San Antonio. So we really like how they do, what they operate. But this deal is truly the first partnership. Throughout the September to January, I could say, this has been one of the best team. How well we work together, willing to pick up, and and very, very polite and considerate of the team members. So it goes a long way in that partnership. But this is the first joint venture for us together. But we have known each other for over a year and a half. From a day-to-day operations perspective, Vinny is the primary decision authority, hiring and firing, as we call it, with me as the backup. And Vinny, you want to talk about active properties in Texas, Central Texas market
Yeah.
to answer that question?
Yeah, no, sure. Dwayne, we own a property in San Antonio. It's in medical center. It's a 117 unit. Also value add strategy, Class C. So it's a type of asset class that we know very well. We own properties in Houston, in the Gulf area. We also own a total of around 400 units in McAllen region. So currently our portfolio is 800 units, only in Texas. We don't do other state, not because we don't want to, but we think the opportunity in Texas is so good and so big that we want to focus in the state, and because it's grown so much in jobs and people coming, migration. It's a great state, very pro landlord, and so we never had any issues with having to evict someone if needed. So it's been a good journey.
Good. Thank you. Another question, how do you guys see where we are at now in terms of the market cycle in San Antonio? So in our opinion, the interest rate cycle haven't quite peaked. It has peaked in the sense that there's no more increase in interest rate, but there's no definitive timeline around the decrease. And that kind of applies to San Antonio market. And San Antonio market being a smaller market, I think it gets impacted a little bit more. And January we got a great rate. if we were to lock that supplement today, after almost a month later, 3 weeks later, I think we would be back to that 8.25, 8.25% type of a interest rate for that supplemental. So, interest rates are fluctuating based on the market response and what happens. Uh, so to answer the question, we think the cycle in San Antonio not quite peaked in terms of what the worst. For this property, being a fixed rate loan doesn't really impact us much at all, as long as we keep our occupancy up and we keep the operation, we should be in good shape. Uh, so from that perspective, but we think later this year, San Antonio market will start to improve from a increase in rents as well as the decrease in the cap rate perspective. So we should be peaking in next 3 to 6 months in San Antonio, which is kind of in line with the rest of the market. But again, personal opinion on that. What is the DSCR currently on the combined loan amount? Thanks, Vinny, for answering. I had Excel open, trying to open that as I was going through this. So thank you for that, putting that out there. Um, Actually, I think the combined DSCR. Uh,
That
okay.
is with the underwriting that we did with 8.24. So with 7.74, it could be, it's not going to be too different from this. It's going to be 1.6 to 2%, two times. I'm sorry.
Yeah, no, you're right. That is 1.6x. Yes. So how many buildings on the project? How many roofs needs to be replaced? So we have well, some of the buildings are connected through the walkways. So if you consider those as separate buildings, it's about 13 buildings. But when you look at the aerial view, those buildings seem connected and it gets a little confusing, but about 13, a group of basically 16-ish package of units, right? So that's kind of what we have there. From a roof perspective, uh, you know, we are trying to see that if we get some of the new technology, then we redo all the roofs, or we may just do only the 2 or 3 max building, 2 buildings where the seller have done a majority of the repairs so far, and those were the most leaking. But we're just trying to assess from a cost benefit perspective for that. Does seller have other assets in their portfolio? We don't think seller has any other properties in San Antonio market. They do have properties in Florida with other partners and other things. Um, Quarterly distribution. Okay, Brooke. So our expectation for quarterly distribution is we usually take the first 6 months as the stabilization period for these. And then the last 2 quarters, we do expect to have a quarterly distribution, which is why the year one is a little bit lower, keeping the first 6 months. So we close in January. So February, March, April, May, June, July is our stabilization period. Uh, August, September, October will be the first quarter for which we will have the distribution, and that would be in November. So we would expect somewhere around 2.25% based on our underwriting in November of this year. So that's our plan, projected plan, and that's when it would be. How has the TVG
That's
other asset in San Antonio performed? Vinny, you want to answer that question?
So we are 2 years invested in a medical center, 100+ unit. It's been good. It's been an interesting occupancy. The capex plan, the property looks so much nicer. We on that case, I would say, we're orbitating between 90% occupancy, between 88, 94. We reached 94. Currently, we're around 90%. So we're still 2 years. There's still 3 years to our exit. But that's been a good market for us. I mean, San Antonio is it's solid. There's growth, and we're being pleased to be in the city, and we're aiming to increase our position.
Yeah, good. There's a comment here. Remember the infrastructure too. TxDOT has over 100 billion in construction cost alone to build over next 10 years. I'm thinking that's a positive comment, but if not, please feel free to chat here. But within Texas, there is a lot of infrastructure that is being invested in, and of course, we have some things on our fingertips for DFW, Houston, San Antonio, Austin market that we can review. Brooke, I'm seeing your direct message. Sorry, took a little while, but we are there. There's a direct message. How much the GP team is putting in themselves. So right now we have a couple millions in on all in all just to close that we did based on the short-term loans. But once all settled and funded, we like to do from each of the GP team at least a 50,000, the minimum investment. So combined, typically we would get to at least a 4 to 5%. We have done higher, or depending on how much we need, we can go there. But we're committing. Shariah and I are putting at least 50,000, and then other TVG team and some of the other members are putting theirs also. What are different exit strategy in case things go south? So this is a great question. Um, One of the big things that goes south in real estate is the financing, right? Like you have your loan, and if it's a variable interest, then what do, right? You're stuck and you cannot get a new loan. You cannot find the money. The money you find is a lot more expensive. If you go to sell, buyers are going to find that expensive money, so that deteriorates your value of the property. So the good thing is for us, like potentially in 3 years we get to our NOI, we want to sell with loan assumption in place. Potentially we have that option. Now, if the interest rates drop to 3%, we don't expect that far of a drop, but it could happen. Uh, Nobody would want to assume this interest, this loan, right? Even 3.78 at that point start to look not a great interest rate. But if the interest rates are in a 5% range, then this loan assumption could still be a great exit for us if we get close to our NOI here. So that's one always there. And depending on the interest rate, of course, a straight exit early or late is there. Now, if things go really south and let's say the rents drop, right? That is a big risk. Uh, but one of the big factor that we look at is currently and projected in the future, the cost of home ownership and the rent. There is a huge gap. So the cost of home ownership is coming down, and the rents have to go up. Uh, and we're using one site, which is a RealPage product. RealPage is a big company with a lot of assets across U.S. markets. So as we look at some of the RealPage forecasts for rent, end of 24, 25, 26, the rent growths are actually in a 4 or 5% in those years. So while we're keeping it conservative, the rent growth is expected to be high to catch up to that home ownership, right? The cost of home ownership. So while that is a big concern, and the rent dropping and us not being able to meet these rents, it's very unlikely in our opinion. Beyond that, if the rents drop, our break even occupancy is around 70%, 73%. So even if we drop down to 70% occupancy, we can cover our expenses here um, for operations. And then, if we are that low in occupancy, of course, we're going to cut other costs. We're going to get our taxes down. We're going to cut other a lot of other things here. So we would save some money on our expenses side whenever the income is lower. So those are some of the things from our things. If things go south, what can we do? Where can we go? Thank you. That was a positive comment about the text dot spend. Thank you very much. Um, Okay, there are some links in the chat. Please click, and at least, even if you're not ready to make a decision on this book, register on our portal, and whoever invited you, pick them as your as a contact there. But register on the portal, please. It's a lot easier to invest instead of last minute. How much was acquisition and disposition percentages? So, we tend to be very transparent, almost too transparent sometimes, but these are all the fees that we are building in. So 2% acquisition, 1.5% disposition, 30% sponsor carry, 70/30, but this kicks in only after the 7% pref is met. Yeah, if you have heard enough to make a decision, please register. How many total number of GPs? So, on the entity itself, as people raise capital, we do make them part of the team. They do get involved on our monthly meetings, site visits, and opinion and opine into there. So, from a individual team perspective, I think we're gonna end up having 5 or 6 GPs. Um, and of course, each team have their own strengths. So we have 5, 6, 7. Yeah. So we would have 7. Uh, great questions. Lively group. Thank you for the questions. What are the questions we can ask? While we're waiting, I think, yeah, this is just a lovely thing. This I-10, this goes towards Houston, about 2 hours from San Antonio. So this is growing in this direction. This is growing in Austin. And San Antonio, of course, has a growth, has the USAA airport. Airport is right about here. USAA whole campus is in this area. So a lot of growth in this direction that's happening. I know. So we have a good crowd here. If you'd like to learn more about this deal, please feel free to connect us. We do have a lot of other deal flow deals. So anything you'd like to learn, please feel free to book a call directly with us. Mike, thank you for posting that link in the chat. Please take a look at the chat.
Yeah.
There's a comment here.
I wanted. Oh, go
Sorry,
ahead.
just to finish. It connects the Texas Triangle. It is beautiful. And so Texas Triangle, Dallas, San Antonio, and Houston with Austin in between. That's the triangle. I read some statistic, just the numbers off the top of my head. 82% of the Texas population lives in this Texas Triangle, in or around this. So just to keep things in perspective, Texas has about 30. Texas crossed just around 30 million now, and imagine 80% of that population in this Texas Triangle, and we are part of this triangle with this property. Mike, you had something to that?
Yeah, I actually wanted. It's a little bit of a comment on the number of GPs, and because it curious, sometimes that question where it goes. But one of the reasons, so we tend to have a few more GPs sometimes on our deals. So Massive Capital is lead TVG. So Massive Capital and TVG are partners, lead GPs on the deal as the companies. And then we work with others, and part of our process and our programs that we have, and it's part of what we've been doing to help others, get opportunities, build credibility, is giving opportunity to others to be a partner in a deal. And they get the experience, they take on some other roles, they'll do some due diligence, they go go to the property, from time to time during the asset management and just check on it, follow up on things. So it creates opportunities for people that are newer and looking for that first deal or first few deals as part of the process that we follow as well. So, but as far as control and management, it is Massive Capital and TVG.